Hey everyone, my name's Andy from Finding Value Finance. I'll be your host today. We've got Justin Hune back talking about uranium. So thanks for coming on, Justin. Really appreciate it. For this is your fourth or fifth time on the channel, I think.
I think fourth. Yeah. No, always good to
Yep.
see you, Andy. How are you?
Yeah, doing well, doing well. So let's start off with 2023 and kind of looking backwards. What are some things that kind of unfolded the way that you thought they would unfold, and what are some things that surprised you about the uranium market this past 2023 year?
Sure. I'll start off with something that I would say panned out pretty much exactly as we expected, and that we actually called multiple times last year, which was the response in the uranium market to the initial higher volume and big price moves that we saw last year in conversion and enrichment. So following Russia's invasion of Ukraine, we saw especially Western utilities go after conversion and enrichment pretty enthusiastically. We saw big price moves, up more than 100% moves for both of those markets in the last 18 months. And most of that happened last year. Saw a big move in conversion this last month, but that seems to be more around kind of the ConverDyn restart for the most part. But yeah, so big volumes, big price moves in those two markets last year. And being that utilities, generally speaking, especially when there's a perceived supply interruption, which potentially there has been and could still be coming from Russian materials to the West, they'll typically go after those two markets first, and they want to secure those services and the products of those services, which is UF6 and enriched uranium, and do so first. That's priority number one, because it doesn't do you any good to be sitting on a bunch of cans of yellow cake and not have your conversion and enrichment booked, especially when both are in relatively tight supply in the West. So once you have those services booked, then you can go out and buy your uranium to fulfill those services. So you buy enrichment, you contract for enrichment long term, you contract for conversion long term. Those are the larger markets. Of course, there's spot conversion and spot enrichment. Say, hey, I need some UF6, I need it tomorrow. If there's none available, you can buy spot conversion, but it's about 40% more expensive than term conversion currently. So you buy those up, and then you have to actually do the calculation in that enrichment contract based on the tails assay that's in that contract. And then you have to go buy the uranium to fulfill into conversion and enrichment. So it wasn't really that bold of a call. It's just how the market works. And if you understand the fuel cycle, you understand that when the utilities buy their enrichment and then they buy their conversion, then they go buy their uranium. Well, guess what? They're buying their uranium. So that's starting to happen. We've seen unofficially basically replacement rate contracting this year. Officially, we've got 153 million pounds booked in the long-term contracting market for U3O8 for 2023. Another 3 weeks to go. UxC's, that's UxC's reported numbers. They basically state that they grasp about 85% of the term market. So, add 15% to that 153 million, and we're basically just about up there to 180 million, which is pretty much more or less the reactor burn rate for this year, depending on your tails assumptions. But let's just say it's 180 million. So we're pretty much there. I think we'll see a little bit more inked. There's a lot of RFPs in the market. Most of the RFPs that have been out there in the term market interest over the past 3, 4, 5 months has come from the EU. These have been non-US utilities, not only in the EU, but primarily in the EU. And the United States utilities still have a lot of uncovered requirements going out for the next 3, 4, 5 years. So they're the ones that are going to need to be coming into the market in heavier volumes. You might think, oh, that's just the United States. Well, just the United States is 25% of global uranium demand. It's a huge market. It's the largest singular market. So they still have quite a bit of buying to do, and we're going to see more pressure in the term market, more pressure in the spot market going forward. So calling that last year, that absolutely panned out pretty much exactly how we expected. There's been a lot of things that have happened or haven't happened in this market over the past 5 years since we've been following it that have gone not exactly as we had expected. Nobody has a crystal ball, ourselves included, but that was a pretty clear call, absolutely came to fruition. Our expectation of a near or at least getting close to replacement rate contracting this year seems to be panning out. I think we'll see some more pounds inked in the next couple of weeks, but we get into the holiday season within the next 10 to 15 days. So not really holding our breath. Doesn't really matter if they're inked in the next 3 weeks or they're inked in January. But I can tell you that there's close to 10 RFPs currently in the market right now, and there's a lot of off-market conversations happening between utilities and producers. Let's see, 2023. What did we not expect? We didn't necessarily expect to see such a rapid price rise over the past 3 months. That's been pretty surprising. And especially because the volumes being traded in the spot market have been declining month over month for the past 6 months. So we've seen the volume being traded continue to decline and the price continue to move up. And so we've got like an alligator jaws type of graph based on volume and price. And what that tells me is that this is not a demand-driven move. It's a supply-driven move. It's a demand-driven move is like what we saw in the autumn of 2021, March, April of 2022, when Sput was in the market buying 10 million pounds over the course of 3 weeks. That was a demand-driven move, and it moved the price handily, of course. Now we're seeing declining volumes and increasing prices. So what that tells me is that this is a supply-driven move, and for whatever reason, as the price has been moving up, supply has been getting tighter, not more liquid. This, of course, is what only a small handful of people were predicting. Primarily, I always like to give credit to Mike Alkin for this one because he called it 5 years ago. Generally speaking, you'll hear kind of the naysayers, oh, we'll hit $50 a pound because Kazatomprom is just going to turn on the taps. We'll hit $60 a pound, and all of a sudden, you know, US ISR and Canada is going to ramp, and Australia is going to ramp, and in no time, we're going to have some supply response, and we're going to see the price capped. But especially from Kazatomprom, they're the fastest to be able to ramp production if everything is going right for them. But what Mike Alkin said back in 2017 was a lot of times in these commodities markets, when you see the price rise pretty substantially, you'll actually see inventories being held more tightly. Absolutely nailed it. Big ups to Mike. That's exactly what is happening right now. Here we are, 81 bucks a pound, and the market is thinner than it's ever been. And not just thinner than it's been since I've been watching it, thinner than Dustin Garrow, who's been in this market for longer than I've been alive, than he's ever seen it. So very, very unique setup. I was surprised to see the price move as much as it did, but here we are. Happy to see it. Equities have had a great year. Obviously, the large caps, primarily we're talking Sput and Cameco, have been the absolute leaders. There's some small cap explorer stocks that have been struggling, haven't moved a whole lot this year. The mid caps have done decently well, 20, 30% on the year, possibly a little bit more. That, in my eyes, is a great year. Anytime you have a year that's returning, 20, 30, 40%, that's a pretty strong year, regardless of what the backdrop fundamentals is saying. With all of that said, here we are at $81 uranium, and I think a lot of people expected equities to be higher here, myself included. I absolutely expected equities to be higher here, but we can't frame the overall macro backdrop. I think there's still a lot of general negative sentiment. I think that throughout this entire year, everybody's waiting for the crash for Black Monday Part 2. One of our members shared a quote. Gosh, I should bring it up in the backdrop here, so I really should. I think it was a Peter Lynch quote. I'm going to butcher it. I'm just going to not say it verbatim, but just kind of paraphrase. Basically saying that a lot more money has been lost trying to avoid corrections than has been lost in corrections. Something along those lines. So a lot of money still on the sidelines, kind of waiting for a big washout, waiting for a broad market induced sell-off of everything. And I don't know if we're going to get it. And because I don't know, I remain long in the things that I do know, and that's mostly uranium. Of course, I'm diversified a little bit to some other plays, but most of my investable net worth is in uranium because I understand this market best, and the price is going higher. I can't, we should get into some 2024 predictions here, but the 2023 recap, the spot price of uranium is up almost 70% year to date. It's been a huge year for uranium. And then it's been a huge year for nuclear too. We can talk about that more if you want, but that's my recap. We nailed the uranium catching up to conversion enrichment, which it still hasn't entirely. There's still a more upside that's going to be happening in 2024 for sure for uranium. We were surprised to see the price move as much as it did. Equities are still offering, in a lot of cases, pretty good valuations for entry, especially compared to the metal.
Yeah, so let's talk a little bit about inventory. We've got a squeezing of inventory in 2023. So the price is going up on declining volumes in terms of the volume that's being traded to push that price higher. Do you think that the supply side in 2024 is going to get better or worse, in your opinion, and why so?
Well, we do have some supply coming online. So there's some production coming from Encore Energy in the United States. It's not going to be a lot, but between Rosita and Alta Mesa, maybe they'll get 500,000 to 1 million pounds. Boss Energy is going to start production, has already started production. Maybe they'll hit 1 million pounds 2024. Paladin's Langer Heinrich, I think its first production from their restart should be next year. We should see the Uzbeks increase a little bit. McArthur River and Cigar Lake they're aiming for full production, 18 million pounds a year. So on balance, all of that considered, we're probably going to see an additional 10 million pounds of primary supply, 2024 versus 2023. We have yet to see evidence coming from Kazatomprom in terms of their CapEx spend, which has about a 9 to 12 month lead time for production, for their production increase for 2024. So they've already stated that they want to get to 10% below their subsoil use agreement levels, which would be, I think it's somewhere 25 to 26,000 tons. And this year we're expecting them to produce just under 23,000 tons. So another 2 to 3,000 tons, which is about another 5, 6, 7 million pounds. That's what they're forecasting for. We fully expect them to come in January, February and say, hey guys, we're not going to hit those numbers, just like they did this year. Earlier this year, they came in, they announced to the market that their 2022 projections for 2023, they were not going to hit them. We know that there's still some problems with sulfuric acid as far as ramping production in Kazakhstan. They are building their own plant. That's still a couple of years away. And we haven't seen the CapEx build. So once you see a big ramp in CapEx, you can expect about a 9-month, 12-month lag time from that to increase production. We haven't seen that yet. So I don't think they're going to be able to increase much at all for 2024, to be completely honest. Still, supply does improve, but it doesn't really even touch the demand improvements as well. I mean, you can expect demand to grow that much, if not more, simply based on tails assumptions. Because we have these enrichment contracts, especially in the West, that are rising in terms of their tails. And the higher the tails assay, I know we talked about this in depth in the past, so I don't really need to get into it, but the higher the tails, the more uranium is needed to go into that same process. So all things being equal, X amount of EUP, depending on the tails assay of that operation for that service, more or less uranium needs to go in the front end of that process. So we have rising tails year over year going out to 2030. And that's because enrichment is constrained in the West. And these new contracts that have been signed with Western enrichers that have been substantially higher in tails assay than what we've seen in the past decade. So even with actual reactor demand, if it were to stay the same, which it won't, it's a little bit higher next year than this year. Rising tails assays means more demand. And that, of course, doesn't even model out for secondary demand coming from financials, coming from producers have been buying uranium this year. I mean, the Russians are buying uranium, the Chinese are buying uranium. Cameco's buying uranium, Kazatomprom's buying uranium. Like, we have a lot of entities that historically have been only sellers in the market that have been buying uranium this year. So we're into this kind of phase of the market where A, it's a seller's market. B, commercial inventories for global nuclear utilities are on the low end. They're not dire. They never ever get dire. So I really don't like the utility panic narrative. I try to avoid that because it's not needed, and I'm an advocate for the industry. With all of that said, they're on the low end, and we're going to be into a restocking cycle of inventory as we are in a rising price environment. So it should get interesting. So supply will be improved next year. We're still going to be multiple tens of millions of pounds short on balance, and that's not going to change until we have either a massive ramping in production from Kazakhstan, which we are highly skeptical of. Yes, they will be able to increase their production. That is going to happen. But are they going to hit? Look, they're calling for 30.5 to 31.5 thousand tons in 2025. That's 80 million pounds. That's like 35% increased production from what they're doing right now. And they're not even spending the CapEx to maintain production right now. So I don't know where they're going to pull it out from. But even if they do hit that, that's coming from 2 large new mines. Primarily, most of that production increase is coming from these 2 new mines. One is a joint venture with Orano, who we know is already short uranium because of what's going on in Niger. And the other is a joint venture with the Russians. So almost all that uranium is going to stay in Russia and China. 3/4 of that production increase is going to stay in Russia and China. So Western demand, which is growing, is not going to really be relieved by a Kazatomprom ramp, is what I'm trying to say here. So we're really honestly waiting for more supply to come online from new large mines in the West. And that's a lot of years away. That's NextGen's Rook I, that's Denison's Wheeler River. Global Atomics DASA. I mean, I can't really call that the West, but it's a Western friendly, company, and Niger pounds have historically gone to Orano and the French and then sold out into the world. And then there's a handful of smaller stuff in the United States that's looking good, but we're years away from a supply response that's going to be able to address this situation. And so basically, to put it simply, we expect the price to continue to have some pressure underneath it until the supply shortfall is addressed. And we're many years away from that. So we're very bullish here. I mean, we've gone from $18 a pound in 2016 to $81 a pound. Something I don't think enough people talk about is inflation. I honestly don't think, and I know you're on top of this as well, probably more so than I am, but I don't think people talk about it enough. They see this $81 a pound mark and they look at the equities and they get disappointed that they haven't moved more. But, that's $55 a pound in 2005 or 2006. The price almost tripled again from that point in 2005. So I think the price could substantially overshoot anybody's wildest expectations. And that's not something we're betting on, but we don't really see where the relief valve is for this. And until that comes, we think there's going to be pressure under this market, and the price is going to keep going up.
So you think the deficit's large enough where it'll basically keep the uranium price up for the foreseeable future?
I do. And it's interesting because when you model in supply and demand in this industry, you have to make a bunch of assumptions. Most importantly would be the tails assumption, but there's other assumptions too. And you kind of have to just take a snapshot of actual, just kind of structural demand from reactor burnup rate in a single calendar year. But that's not how the industry operates, right? Because so we know that we can say, okay, for 2024, 5, and 6, we have X amount of supply shortfall, right? I mean, between those 3 years, we probably have a cumulative shortfall of 50, 60, 70 million pounds between those 3 years, maybe even more. But we also know that during those next 3 years, the primary sellers of uranium are almost entirely sold out of uranium. So any utility that's going to be signing contracts and trying to secure pounds, I mean, God help you if you're trying to find 5 million plus pounds in a short to midterm contract starting delivery next year. It's going to be very, very, very hard to even find that anywhere. But you go out a couple of years, you're going to find it, but you're going to pay up for it. And so the primary producers are almost entirely sold out of that material out to 2027, 2028. So the buying that needs to happen between now and then is greater than the supply that's going to be available. So what we're going to see, I don't think we're going to see a situation where a utility literally can't get fuel and has to shut a reactor down. Like, knock on wood, I hope that doesn't happen. But we are going to get into a situation where we're going to see bidding wars. We're going to see bidding wars between the utilities. And like I said, God forbid, we don't see money piling into SPUT or into Zuri or into this new PFYN fund that's going to pop up any day now. If capital flows, if the financial markets smell blood in the water and capital starts flowing, then we're going to have utilities, in bidding wars against Sprott. And that didn't happen the last time. The last time Sprott came in the market, utilities stepped back and said, okay, here comes these capital flows. Let these guys ramp the price up, and then they let it fall back down. Right. So we had these spikes and it fell down, higher lows, but still fell. So it was wise for the utilities not to chase and come into the market competing with Sprott. But now we're in a situation where the market is so tight, supply is so tight, and available supply for that 2024 to 2027 8 period is so negligible that we're going to have industry competition for those pounds. I can almost guarantee it. So that is a whole different ball game from what's the marginal cost, right? Because when the market is sort of tepid and you're betting on a reversal, like a contrarian bet from a terrible market to a recovering market, then you can say, okay, where does the price need to go to? And that's sort of your thesis. So you're at $25 a pound and you can say, okay, well, here we are at $25 a pound. The equities are dirt cheap. Where does the price need to go? And you kind of have to attach yourself to that narrative because there's no other narrative at the time. There's still some above ground mobile inventory floating around, utilities still engaging in carry trades. Sprott hasn't taken over UPC yet, so they only buy when they can raise cash when they're at a premium, and they only do that once every 2 years or whatever it was. So your narrative has to become, okay, where does this need to go just to balance the market and get that marginal pound? So 4 years ago, we're looking at this market going, it's got to go to 65 because that's what Bannerman needs, right? So whatever. And I continue to look at these big Namibian projects because that's where we have low grades, but a lot of uranium. And we're going to need those projects in the early 2030s and beyond. We're going to need those to balance the industry, 100%. So what they need matters as far as that marginal cost. What is that marginal pound worth? But when you have a situation where you have this vital industry and these players within this industry are potentially going to be competing with each other for minimal amount of supply, then you can throw that marginal pound necessary cost just out the window. Because then it's, well, what is it worth to you? That's what the price is. The price is whatever anybody's willing to pay. So yeah, the marginal pound still matters. I mean, it still matters that we need to now, inflation adjusted, probably get to $9,500 a pound for, you know, the low grade projects to come online. Yep. But, you know, we hit that price. It doesn't mean that all of a sudden we've got Etango producing uranium. They still have to raise $300-400 million in a couple of years to build out a mine. I'm not just singling them out. You know, Bannerman, Deep Yellow, Forces, there's a bunch of big development projects in Namibia that are all going to be necessary. But those take years to develop and, you know, combined billions of dollars of capital. So there's just no short-term relief. So I think we have a pretty exciting few years ahead of us, Andy. Yeah.
Yeah. So here's a question, kind of how this thing maybe will play out over the next year or two or longer. Do you think we're going to shoot up on the uranium price still, and then the equities will eventually follow? I know Cameco's been our leader. It's been really taken off. Do you think these little junior guys are going to start playing along here at some point? What point do you think that may be? What do you think a potential catalyst could be? I know a lot of people like talking about catalyst. Is it the uranium price hitting $100 a pound? Is it 85? I don't know. Whatever that poundage is, kind of what's your take on these kind of equities starting to come alive? What's it going to take, in your opinion?
I think it's already happening. It's just happening slower than kind of impatient retail investors want to see happen. And a lot of the retail guys kind of avoided Cameco because it's a large cap and it's the obvious stock. And I think that people want to try to think that they're more sophisticated than just buying the obvious stock. And this has been one that it's an institutional darling. It's highly liquid, it's large cap. So if you're managing hundreds of millions of dollars into the billions and you say, oh, I like this thesis, I want some exposure to uranium mining, what are you going to buy? You're going to buy Sput, you're going to buy Cameco, maybe NextGen or Paladin or Denison, maybe one of the ETFs, and that's pretty much it. And you're not going to touch anything else because it's not liquid enough. And that's what's been happening. So we continue to see an outperformance of the large caps. And I think that happens until we see more of a frenzied move of capital into the space. And when that happens, they go into the ETFs, especially retail. Institutions will buy ETFs, but they're majority owned by retail. And so we kind of need some more retail enthusiasm around the sector. And I think it happens. Historically speaking, especially for the uranium market, we can look at what has happened in previous markets and when did we start to see a rotation, sort of not necessarily out of the large caps, but an outperformance of the small and mid caps, explorers and developers outperforming the large cap producers. And that happened in the previous market right around this level, inflation adjusted. So it was basically between $50 and $60 a pound is when we started to see that rotation. Not to say that it has to happen again right at this particular moment, but it's also sort of classic. I just think that this market is more drawn out than most kind of metals or commodities investors are used to. You can see a much faster spike sort of move in a commodity happen over a 2 to 3 year time frame. This very well could be a 10-year investment, and maybe we're 3-4 years into it. So so far, this first leg, if you go back, honestly, if you go back from the COVID lows or the commodity lows, you're going to see there's a lot of small and mid caps that have vastly outperformed Cameco. It's just really in the headlines this year because it's had a banner year. I think it's up 70% or something like that this year. It's a huge year for Cameco. But if you zoom out, there's still plenty of outperformance for some of these smaller caps. But I think over this past year, let's say 2 years since we consolidated off of that big move in the autumn of 2021, we've seen the large caps sort of lead the way. And that's actually what you want to see, because that's prima facie evidence that smart money is positioning in the sector, and that's good. So even if you're holding on to some lagging small and mid caps and see Cameco running, you should feel a little bit reassured by that, because that means that the sector is starting to garner attention. I saw somebody share with me the other day that it was 30 something large funds in Q3 had positioned. I think it was in either Cameco or the Sprott Physical Uranium Trust. I forget, I apologize. But it was a substantial increase in the number of large institutions that were buying into the sector. So I think that slowly but surely, the sector will gain attention from generalists, and we'll see money continue to move in. The ETFs continue to issue shares and buy the underlying holdings. Money is flowing into these things, even when the stocks are moving kind of sideways and there's some selling pressure coming from retail. That's probably influenced by just kind of the overall sort of soggy sentiment in stocks in general right now. But I think that changes. And I also don't have short-term concerns. I'm not really worried about what happens in the next 6 months. You know, I'm here for the long run for this market. And if it takes a little bit longer for that to happen, that's okay with me. Patient capital, I really try to emphasize that, especially for my own personal investing, and to also to our membership, to be patient. We watch the physical market. We know what's happening there, and that underpins our confidence in everything else. So when will the equities go? I don't really know. Do I think that they will? Yes. Do I think that the small and mid cap explorers and producers are going to outperform Cameco and Sprott and NextGen and all of those? I do. I think that they will. When exactly that happens, I don't really know. But it is a classic. If you're a new investor and you're watching this, this is classic for metals and mining stocks to see the large caps move first. It's classic. And we've seen that over and over in the precious metals markets, where it's that last, inning 5, 6, 7, 8, 9, where you see the juniors just really launch to the upside. We haven't seen that yet. It hasn't happened yet in uranium. So take some solace in knowing that maybe despite the fact that you're here 5, 6, 7 years after the commodity bottomed, you might still be early when it comes to the equities. That's what's kind of exciting for me, because the commodity going higher is very, very solid. I believe that strongly.
So looking forward the next year, I know a lot of people ask me this question. I don't have a good answer, and you probably won't either. But it's Camco's been ripping it. It's been outperforming. And some people will say, is it time to rotate out of Camco into some of these smaller names? Or is it time to start looking at the smaller names because they haven't moved and Camco's been ripping to the upside? What's your take there? Is it a lot of people, what they'll do is they'll look at a small cap, it doesn't move for a year, they get impatient, and then they go and buy Camco because it's moving. So is that something that you think will continue going forward? Or do you think maybe the juniors are going to start, maybe we should sit on these juniors and just give them time? And no advice or anything like that, guys. I'm just trying to get an opinion, because a lot of people ask me that question. I'm like, it's tough to know.
It is tough. I think that's really an individual choice more than anything, because you have to consider a bunch of things. If you happen to have owned Cameco and still do now, and you're considering rotating out of it into other stocks, depending on where you live, you have to consider your tax implications of making that sale. You also have to consider, I always think about somebody's age and how important the money is that they have invested. Is this your retirement money, and it's highly, highly crucial that you hang on to every penny of that money? Well, you probably shouldn't even be in the uranium sector because it's just so volatile. But, Cameco is highly liquid. So if you have a large position in Cameco, and generally you're a higher net worth investor, you might not want to sell that and pepper it into 15 different juniors, because then it's going to be way harder to watch and it might be stressful. It's really an individual decision that it's impossible to say what someone should or shouldn't do. For me personally, I think that there's a handful of highly overvalued stocks in the space that I would be rotating out of and putting money into some of the stocks that are much better value propositions here, without naming names. I'm not saying Cameco is necessarily overvalued. I think there's kind of this cool X factor with the stock right now, especially with the Westinghouse deal. Now they're this vertically integrated nuclear energy stock. They're not just a uranium miner. And that's pretty cool and exciting. And I think that the story around Cameco is just getting better and better. So it's hard for me to say, yes, you should sell Cameco and go buy, Aura Energy or something. Like, I would never recommend that. But, just diversify, take your own age, your own risk tolerance, your own liquidity requirements, your own jurisdiction and tax implications, all of those things you have to take into account when you're talking about moving positions around. I don't really like to move positions around that much. I generally buy and hold. I buy on weakness and hold because I believe this is going to be a multi-year bull market. I don't like paying taxes. So you actually talked about this in your previous video, Andy, and I thought you said it really intelligently, probably more than I'm about to say it. But if you're in the US and you sell and reset the capital gains clock, let's say you sell the stock that you've held for more than a year, and that's a long-term capital gains, which is a lower rate. You have to understand that if that's a position you intend to continue to hold for this bull market, and you are hoping that we are at a near-term top and it's going to pull back, you have to consider two things. You have to consider, or maybe three things: how much taxes you're going to pay on that sale, how much does it have to pull back for your entry to be that much improved to actually lower your cost basis going forward, and three, what if we see a super spike in the next 11 months and you have to sell out that position now at a short-term capital gain? You would have lost money even if you got a better entry. So these are things you have to think about. And for me, I just like low stress investing. I don't like to baby my positions. In fact, most days I don't even look at my my brokerage accounts. I really don't. And so when I know there's a little bit more cash in there, or I know we're in a pullback, if I see a nasty comment on YouTube or Twitter, it's like, oh, well, let's check the RSI. Usually they align. Low RSI means let's hate on Justin, and overbought RSI means I see memes on Twitter with, you know, me having long flowing hair and a crown on my head or something, carrying a sword. So I don't even watch my account very often, and I like long-term capital gains, and I like to hang on for the long term. So that's just me. With all of that said, I do think now-ish, and in the next, let's say 6 to 12 months, is probably a period of time where we're going to see new attention come into the sector, especially with a great backdrop of nuclear energy support on this COP conference. We can chat about that if you want. I think we're going to see some new money come into the sector, and we're going to see the small and mid caps probably outperform the large caps going forward. That would be my blanket guess, but each his own.
Let's talk about what inning we're in. So, or however you want to say it. If we're coming through this uranium cycle, where do you think we're exactly at the cycle? You know, I look at things like, you know, are the big guys moving? That yes, they're starting to move. Are the juniors moving? Not really. So it means that we're still early the way that I view it. What's your viewpoint on kind of where we're at in this cycle? And as growth comes into the mix greater and greater than maybe expectations, does that push the cycle? You know, are we earlier in the cycle than what we even think? So, you know, what's your opinions around that?
It's very, very difficult to say. I mean, I don't know what inning we're in, Andy, but the last thing that you said there, are we probably earlier than most people think? I think so. I think that we are. One of the most intelligent things I've seen written in a while on the uranium market came from Gehring and Rosenzweig, and they just put out a recent report on a number of commodities, including uranium. They're super bullish on uranium here still. They think we're going to see prices way beyond what anybody's expecting. And I don't really know. I don't like making price targets for the commodity, but I agree. We're probably going higher than most people think we will. But they're trying to sort of figure out what's going to stop this price acceleration for uranium. Like what's going to cap this? And I agree with them. They don't think it's going to be a demand reduction. That's what caused the previous bear market, right? So you had the Fukushima Daiichi accident, Japan's reactors coming offline. It was a hit to demand. At the same time, we saw production continue to increase. So I suppose it was somewhat supply driven, but most of that production was coming from Kazakhstan that was 100% state owned, largely influenced by Russia, making a currency play, rapidly depreciating Kazakh tenge, paying their production costs in tenge and selling in dollars. And they just did it until the price was at $18 a pound, which happened to coincide with the peak year of their production. But that was a demand shock, 10% of the world's demand offline within a 12-month period. So going forward, I tend to agree with Gehring and Rosenzweig. I don't expect a big demand shock again. And that of course would be the big shock of this market. If something happens to instigate a major decline in demand for uranium. I have a hard time seeing what that could be. Even if, knock on wood, hopefully this doesn't happen, but even if we did see another nuclear accident, which of course would be terrible for sentiment in the short term, I'm sure it would be bad for the stocks in the short term, but would it cause, like, let's just say something happened at Zaporizhia in Ukraine, where there's been five of the 6 reactors in cold shutdown and 1 is minimally operating, but they continue to have, like, just last week they had to run on diesel generators again because the grid got cut off from fighting nearby. This has happened 8 times in the last 18 months. The market doesn't even pay attention to it anymore. But let's say there's a partial meltdown of one of those reactors. I don't think it's going to happen, but if it did, do you think China is just going to stop building their nuclear fleet? I really don't think so. Do you think all of these countries that are pushing for life extensions and potentially even building new nuclear are going to reverse course because there was a partial meltdown due to some unforeseen circumstance? Probably not. Now, that's not to say that I hope this happens. Of course, I don't. But I think the demand story is stronger than it's ever been for nuclear energy, and therefore for uranium. I think it's very strong. So I tend to agree with Gehring and Rosenzweig. I think it's going to be a supply thing. So you have to realistically look at supply and understand when is it that we'll see enough supply to balance the market. And I hate to say it, but Kazatomprom is not going to be able to do it alone. But if we have, let's just say they don't hit it in 2025. Let's say 2026, 2027, maybe they get to 30,000 tons, 76 million pounds, right? That's another 15 million pounds out of Kazakhstan. Half of that is Kazatomprom 100% basis. Or attributable, and then the other half is to their joint venture partners for their various projects. The Uzbeks are going to ramp million and a half pounds a year. That's their plan anyways, going out to the end of the decade. We'll have another 5 million pounds out of the US, maybe 3 or 4 years from now. Australia, there's some big stuff in Australia. A lot of the big projects are in currently illegal jurisdictions, but some of them aren't. We could have some more out of there, but that's not happening in the next 5 years for these big projects in Australia. Namibia, Bannerman, Deep Yellow Forces, when are they actually, realistically, when do you think they're going to produce? And again, they just happen to own projects that are low grade, so they need higher pricing, and they're big. They're going to take some time to build out, but I don't think any of those new projects in Namibia are producing in the next 5 years. I really don't. Then we go to Rook I and Wheeler River in the Athabasca Basin, Arrow and Phoenix. Those are both companies are saying 2028. I think that's optimistic, especially for Arrow, but maybe. So best case scenario, I think we're looking still at 4 or 5 years before we even approach a balanced market. And that, of course, is without any substantial demand coming from SMRs or coming from financial players as secondary demand, or some massive restocking of inventories. Like, all of those things sort of juice up just this structural annual demand coming from reactor burnup. So that's when I think things slow down, is when we see supply. Now, could we hit $200 a pound and all of a sudden we see some inventories come into the market from the Chinese or from whoever else? That's possible, right? It's hard to say when we can see some of the larger inventories being held might be sold into the market. That could happen. China has a lot of uranium, but they don't have a lot of uranium in the ground. And so to me, it doesn't make sense for them to sell down this vitally important strategic inventory that's essentially held by these state-owned corporations, to sell that inventory off unless and until they can replace it somehow at prices lower than what it's being sold at, and in volumes at least matching off or greater than what it could be sold at. So as of now, we haven't seen any evidence. Now we're $81 a pound uranium. There's no evidence whatsoever any of these entities that are holding uranium are selling that inventory into the market. They're holding on to it more tightly and, in fact, turning to buyers. So we have a ways to go. With all of that said, we follow the physical market very, very closely. So when we start to see pounds being sold into the market from either hedge funds or from some of these large inventories, state-owned inventories, we're going to be the first to know, and our membership is going to be the first to know. And that could stem the tide of a rising price, at least temporarily. Could. But mined supply fixing this deficit, we've got 4 to 5 years minimum before we see a truly balanced market in as far as supply and demand on an annual basis.
Let's talk about demand real quick too. Didn't something go through where we just tripled demand for nuclear, or something that just went through?
Well, I don't know if I would say it went through necessarily, but what just happened over the weekend was basically a pledge, an official pledge that was signed by I think 23 or 24 countries at this point at the Conference of Parties, the COP conference. This has been going on since this is COP 28, so 28 years. It was held in Dubai. The United Arab Emirates sort of famously have recently built 4 large reactors. Actually, the Koreans built the reactors at the Baraka plant. Absolutely brilliant, on time, on budget, beautiful. It's now 25% of their electricity is coming from this one nuclear power plant with 4 reactors that they built over the course. I think they built all 4 in less than 10 years, if I recall correctly. Just absolutely brilliant and totally on budget. So they hosted this conference, and at this conference, this pledge was to triple nuclear power globally by 2050. So that's a lot. And that was, I don't know the countries off the top of my head, but it's the big ones essentially. And they're all, it's the United States and Canada and the UK and some Norwegian countries, some EU countries that are all committing to this. So that, and of course, it's part of that is to reach a net zero goal of 2050, right? So, which, I'm skeptical that that's going to be hit, but is what it is. At least they're aiming in the right direction. Kind of physics is winning. So to give you some context, up until last year, nuclear energy never even had a seat at the table at these COP conferences. So it was all about renewables constantly. And this is a conference essentially to address climate change and concerns on that front. Just last year, for the first time, there was actually even discussions about nuclear. There was a handful of tables that were discussing nuclear. Oliver Stone premiered his film there, the Nuclear Now film. That was supposedly standing room only. That was last year. So that was a big deal last year for the first year. And then this year, to have all these countries sign on this pledge, I think is huge for multiple reasons. But I think the primary reason, because who really knows exactly what all of the countries that signed this are going to pledge in terms of their own financing commitments and how aggressively they will do this. But to triple by 2050, you have to also consider there's going to be, dozens, if not more than 100 reactors shutting down between that time period also. So for total capacity to actually triple by 2050, we're talking about a more than tripling of the existing fleet, because you have to factor in those shutdowns. But what I think the biggest thing coming from this is basically, it's kind of like a big vouch for nuclear. This is a very mainstream event, the COP conference, for the quote unquote climate concerned. And for the conference to embrace nuclear and to have all these countries sign on saying, hey, we need to do this, that sort of gives the A-OK to pretty much everyone to say, okay, nuclear is okay, and we can pursue this. Leading up to just the past few years, when we've seen sentiment drastically shift towards the positive for nuclear, it's still sort of a curse word, in a major portion of the world. You're not even considering building nuclear. Well, that's shifting relatively quickly. So that also, that just kind of underpins this whole investment thesis, because the investment thesis really for any commodity, you basically look at supply and demand, try to model out into the future both of those things and say, okay, we're going to see an excess here, or we're going to see a shortfall here. And that's your thesis for the price of the commodity, and therefore all of the companies that are dealing in that commodity, right? That's the core thesis for uranium. But when you can underpin that with this beautiful foundation of a re-embracing of nuclear energy, which is the consumer of uranium, Andy, I never would have thought I would be seeing these type of headlines, not in my wildest dreams, even just a few years ago, to see the COP conference, 20 something countries pledging to triple nuclear. It's like, can't even believe what I'm seeing. It's incredible.
Here's a question. I know you started Uranium Insider 2016 or
2019. Yeah, I've been following the market since 2016.
Okay. So you've been in the market. So when you look at the demand data from 16, 17, 18, 19, 20, it's growing way faster than what we were thinking back during those timeframes, right?
The modeling out into the future is so the actual growth that's happened since 2016 isn't drastically more than was projected at the time because of how long it takes reactors to be constructed. So in 2016, the demand that's come online since then was pretty much baked in because those reactors were already being constructed. But to project out to 2035, 2040 now versus then, huge. It was because back in 2016, we were looking at 1 to 2% compound annual growth rate, maybe largely driven by China. Now we're talking about 3 to 4% compound annual, which is a massive, massive shift.
You think we're still on the low side for demand? Do you think that's going to continue to pile on as time goes on in terms of demand?
I do. And, I think that this investment is a really, really unique point in time because if we do see this move towards expanding nuclear anywhere even remotely close to what they're calling to be done, I don't even see how mine supply can feed into that demand. So, and there's enormous amounts of uranium in phosphates, like 80 something percent of the global phosphates are in Morocco, and there's billions of pounds of uranium in these phosphates in Morocco. It's just expensive, and it's a technology of extraction that isn't really all that proven out at this point. The Russians and the United States have been looking at Morocco, trying to make, even there's an article earlier this year, the Russians are trying to come in and sort of be like, hey, we'll build you guys a power plant, then you can get some desal and fix your drought. By the way, then we'll get access to your phosphate uranium. There's a ton of uranium there. There's a lot of phosphate tails in China and the United States with plenty of uranium. There's a lot of uranium in the ocean, which is expensive and energy intensive to extract it. But it's highly likely, I think, at this point, given the trajectory of this industry, that we're going to get through this bull market for the commodity. A lot of mine supply is going to come online in the next, let's say, 8 to 10 years into the early 2030s. The commodity will find its new base price based on those projects and wherever the pricing levels are at that time. I don't know what that's going to be, $150, $200 a pound. I don't know. And then if we see growth happen in the way that sounds like it could, we're going to need kind of beyond mining. I really think, and I hope that happens, right? Because I don't necessarily need this bull market to last until I'm 75 years old here. I'm happy for this to be another 3 to 5 year bull market, and we see supply come online to kind of stem the tide at the moment. But the nuclear advocate and humanitarian in me wants to see nuclear triple by 2050, and that if it does, we're talking about 500 million pounds a year of uranium demand. That's a lot, and that's probably more than we want to just pull out of the ground in massive open pits all over the world. So hopefully those technologies make themselves available. And I think, things like Global Laser Enrichment, there's some other isotope enrichment companies out there that are working on uranium enrichment, and that technology grows. We could see, a lot of tails being laser enriched into UF6 and into EUP, and that could help. So yeah, there's a lot of technologies out there. They're just higher priced. They're not that well fleshed out. And in the meantime, we have this brilliant opportunity to profit, for lack of a better word, from the growth of nuclear prior to a high price and new technologies that hopefully will be the future of uranium production for the growth of nuclear, going out into the end of the century. So for now, hanging on. I think we're going way higher. I think it's going to be a multi-year bull market. I'd never even answered your question what inning is. I just don't know. If you had asked me 2 years ago, I would have said we were in the third or maybe even fourth inning after Sprott went after it. Now, looking back and seeing what's happened on the supply side, I think we got a big reset, and seeing what's happening on the demand side and the growth of the sector, we might still be in the third inning 2 years after I would have said it was the third inning. It's a moving target. So I don't really know. I know we haven't seen a speculative blow off top. We haven't seen that yet. And it could last a lot longer than you or I are expecting. It very well could.
Is there any other questions I should be asking that I haven't asked that you want to share with anything? Any other information?
I think that there's some analysis that's being sort of spread around Twitter that is looking at company valuations and is looking at trying to get into the weeds on some elements of reactor burnup rates that I think is completely missing the target. And without being specific about the folks that I'm talking about that are doing this work, first of all, I commend anybody who's doing any work, even if it's misdirected or misguided, or just going in the wrong direction. So looking at burnup rates and geeking out about tails assays, I think is important. And it's important to understand what the actual true demand is for uranium, right? You have to understand that. But it's also important to look at the actual physical market and see what's happening right now on the ground. So what's happening right now on the ground is last month we saw a $3 move in the spot price on 0 pounds traded. So that doesn't have anything to do with burnup ratios. It doesn't have anything to do with tails assays. It basically has to do with sort of animal spirits and sentiment. And when we're talking about minimal pounds being available in a market and multiple buyers in that market, you can almost entirely just throw supply and demand modeling out the window and just look at a snapshot of this market. So what we're seeing is a clear trend in the price, and everybody in the industry is recognizing that trend, especially highlighting the nuclear fuel consultants, who historically have been very conservative and very tepid, are basically waving the white flag, and they've got the smelling salts, and they are awake, and they are telling their constituency, their readership, which are nuclear utilities, things are going higher, guys. I can't guarantee you we don't see any supply. It's coming into the market to fix this anytime soon. Buckle up. I mean, this is what they're telling the utilities, and these are the people that follow this market every single tick and every single element of the fuel cycle at every hour of every day. And they are here saying, there's no supply coming online. We don't think it's going to happen. So hang on, because it's about to get wacky. That is important. I had a thought come to me just a minute ago, and I think I lost it, going out into next year. It's okay. I think we can
reel it back in.
I know. I think we can probably end there, but yeah, it's important. It's very, very important to recognize what's happening in the physical market, because the supply and demand modeling that matters. It's important to do. It's important to make a projection going out into the future, but understanding what's happening right now is crucial. And we've had, sorry, I'm going on and on, but all of these things are so fascinating to me. We had an RFP that came out very public about 6 weeks ago, or maybe 8 weeks ago, from a Korean utility. And historically speaking, supposedly, and this is according to our friend Dustin Garrow at Nuclear Fuel Associates, basically that historically speaking, the Koreans have kind of, they sort of, I don't want to say they bully the market, but they come in, they go, hey, this is what we're looking for, and this is what we're going to get. And they put this RFP out with very specific floors and ceilings. It wasn't even a negotiation. Usually an RFP says, we need 5 million pounds delivered from 2027 to 2032. They don't dictate the pricing. They put it out there, and then multiple suppliers will bid for that contract, right? That's how the RFPs work. Well, this RFP came out and said, we're looking for this at this floor and this ceiling. And they didn't get filled. They didn't get filled. And it was a decently priced floor and ceiling. It was floors in the 50s and ceiling, I think, in the 80s or 70s. So not kind of completely ridiculous, these pricing numbers that they were putting out there, but they didn't get filled. So that's interesting. It's just a full-on seller's market. It's a full-on seller's market. And there's a lot more demand coming next year. Oh, that was the thought. And we'll end here because I got to get off the rambling soapbox. Last year, a lot of what happened, and I think this largely influenced the U.S. utilities, which is why they've done less buying than the EU and the other non-U.S. utilities up to this point. With some exception, the large U.S. utilities are pretty well covered. They're very smart. They make sure that they cover their needs, usually a lot sooner than the smaller and mid-sized utilities in the U.S. But last year, following the Ukraine invasion, a lot of utilities just sort of stepped back. Well, after they secured conversion and enrichment, which a lot of them did, they kind of stepped back on the uranium front, sort of just to see if this situation would blow over. And basically because they can buy uranium from Russia or Russia-friendly countries like Kazakhstan. They still can, but there's been a lot of problems with shipping. And there's a lot of, even if there haven't been actual official sanctions or actual interruptions to shipping, there's a concern as this bifurcated market continues that if I sign a contract right now with Uranium One for delivery in 2026, well, something's going to go down between now and then, and I'm not going to get my fuel. And so security of supply always is paramount. And whenever that is threatened, the utilities do act on that. So it's not necessarily making a political statement, but basically for them saying, okay, we're actually concerned that this situation could worsen. And between the time when we sign a new contract and the time when that is delivered, chances are there will be sanctions at that point, or for some reason, we won't be able to get that material. So what a lot of utilities did in 2022 was kind of sit back and hope that this would blow over. Well, 2023, especially towards the end of 2023, now is when we're seeing a lot of RFPs coming in the market. For the past 3 months, they've been coming one after another after another. I think there's 7 or 8 in the market right now officially. Historically speaking, that's pretty good activity, especially for December, you know. So it's sort of been a reckoning. It's kind of like an understanding that this situation hasn't gone away, might not be going away in the near term. And there's still a high likelihood that material coming from Russia and possibly even Kazakhstan could be impacted going forward. And so all of those utilities that were fence sitters last year are going, all right, if we need to cover our uncovered needs in 2026, 2027, we're going to have to shit or get off the pot, pardon my French. So they're all sort of coming to the table right now. And they're all competing for the same pounds because there's not very many people producing uranium. Kazatomprom and their joint ventures, Orano and Cameco, BHP, the Chinese out of Namibia. I know I'm missing a couple of smaller ones. Oh, the Uzbeks, right? Those are the big producers right now. And the Uzbeks pretty much sell mostly into offtakes to traders, and traders carry trades and sell to utilities and trade uranium. But Kazatomprom, Cameco, Orano, Uranium One, CGN, CNNC, usually engage in long-term contracting. And the pounds they have available, the forward production is already almost entirely sold out going to 2027, 2028. So, man, I don't know what's going to happen, Andy, but it's important to understand that a lot of utilities did sit back last year, and they're coming to the table now. They're going to keep coming to the table next year. And we're starting to already see these contracts get longer. So instead of securing for 5 years, they're securing for 8 to 10 years. And they're going out into the mid-2020s, mid-2030s. We're actually seeing enrichment contracts already go out to 2040 right now. That's how far ahead this industry operates. So it's all coming to a head right now. And I'm feeling pretty excited about 2024.
People want to follow your work. How do they do that?
uraniuminsider.com. That's our website. You can find me there. Feel free to reach out if you have any questions. And I'm also on Twitter at Uranium Insider. So those are the two primary places. Just to reiterate, we basically focus almost entirely on the macro fundamentals of the sector and the especially the fuel cycle and the physical market. And that has kept us in this trade and kept our members in this trade. There's been plenty of rug pulls. We're going to have more. Just because I'm bullish and I think we're going to be, north of $100 a pound in the next 12 months, which we probably will be, doesn't mean we don't have a correction or two in the 20 to 30+% range in the equities. That's going to happen. So you have to understand the fundamentals. You have to understand the physical market to hang on in this market, because it's not easy. We've got an exciting webinar guest for December as well, that we're going to geek out on the physical market too. So yeah, you can reach me there or on Twitter.
Okay. Well, that's all I've got, guys. Thanks for coming.
Thanks, Andy.